Today's financial landscape is shifting as markets respond to new economic data. The latest jobs report has sent ripples through Wall Street, while tech stocks face mounting pressures. Stay tuned as we count down the top 10 stories impacting our world today. Global stock markets saw mixed movements today, driven by anticipation surrounding the Federal Reserve's upcoming decisions on interest rates. Following the lukewarm U.S. jobs report, global indices showed a slight uptick, reflecting investor optimism. Asian markets opened with volatility, while European stocks gained traction on hopes of a dovish Fed stance. The British pound also showed signs of strength, nearing its most significant weekly jump against the dollar in the last 3 months. Analysts suggest that the mixed performance reflects a broader caution as investors await clearer signals from the Fed. While some sectors are buoyed by the easing of rate hike expectations, others remain wary of persistent inflation and geopolitical tensions. The coming days will be crucial as traders digest Fed communications and earnings reports, seeking clarity on market direction. Bitcoin has surged above the $62,000 mark, marking a significant moment for cryptocurrency enthusiasts. This increase follows the release of the disappointing U.S. jobs report, which has led to a shift in market sentiment. On-chain data indicates a hidden buying surge, with net outflows from Bitcoin exchange-traded products reaching a monthly high. Despite the positive uptick, the cryptocurrency market remains under pressure from a longer-term bear market that has erased trillions in paper profits. Investors are cautiously optimistic, watching closely for signs of a sustained recovery. The recent rebound in Bitcoin's price may suggest a potential shift in market dynamics, but many investors remain wary given the recent volatility. As we move forward, the focus will be on how Bitcoin performs against ongoing bearish sentiments in the broader crypto market. The U.S. Manufacturing Purchasing Managers Index, or PMI, has indicated continued expansion in the manufacturing sector, coming in at 53.3% for June. This figure, while slightly below May's reading of 54% and the forecast of 53.8%, remains above the critical threshold of 50%, which signals growth. This marks the longest expansion streak for U.S. manufacturing in 4 years, underscoring the sector's resilience amid ongoing economic uncertainties, including inflation and supply chain disruptions. Analysts view this steady performance as a positive sign for the economy, suggesting that manufacturers are adapting well to current challenges. However, the slight dip could raise concerns about future growth momentum and the potential impact of rising interest rates. As the economy transitions, manufacturers will likely focus on innovation and efficiency to sustain this positive trajectory. Continued monitoring of manufacturing trends will be crucial in the coming months, especially as firms prepare for potential shifts in consumer demand. Drone manufacturer AeroVironment has seen its stock rise over 5% following the announcement of a substantial $500 million contract with the U.S. Army. This contract highlights the increasing reliance on advanced technology in defense, specifically in unmanned aerial systems, which have proven crucial in modern warfare. The U.S. military's commitment to enhancing its drone capabilities reflects a broader trend of prioritizing technological superiority in defense strategies. As tensions escalate in various global regions, demand for reliable surveillance and combat drones is expected to grow significantly, which bodes well for AeroVironment. This contract not only boosts investor confidence in the company, but also positions it as a key player in a rapidly evolving market. Additionally, other firms in the defense sector may benefit from increased defense spending, leading to a ripple effect across the industry. Looking ahead, AeroVironment's focus on innovation and its ability to fulfill contract obligations will be critical as it seeks to solidify its market position in this competitive landscape. Major tech companies are facing renewed pressures as a European court upheld a $4.1 billion antitrust fine against Alphabet, the parent company of Google. This ruling highlights the ongoing scrutiny these tech giants are under regarding competition practices, particularly within the European market. The fine stems from allegations that Google abused its dominant position in the online advertising sector, stifling competition and innovation. Following the announcement, Alphabet's stock fell approximately 1%, reflecting investor concerns about the potential financial implications of the ruling. Other tech stocks, including Tesla and Meta, have also experienced declines amid broader market pressures, indicating a ripple effect across the sector. The antitrust landscape is becoming increasingly complex, with regulators intensifying their focus on market dominance and competitive practices. As these companies navigate the challenges posed by regulatory scrutiny, they may need to rethink their operational strategies. In the coming months, investors will closely monitor how tech firms adapt to these evolving regulatory environments, potentially reshaping the industry's landscape. The Dow Jones Industrial Average has surged nearly 600 points, closing at a record 52,900.07, reflecting strong institutional support despite a mixed performance in tech stocks. This record high is significant as it indicates investor confidence in traditional sectors like finance, energy, and consumer goods, even as tech giants face ongoing volatility. The market's rally comes partly in response to a weaker-than-expected jobs report, which has led traders to reassess their expectations for upcoming rate hikes by the Federal Reserve. This reassessment suggests that the central bank may adopt a more cautious approach, focusing on sustaining economic growth rather than tightening monetary policy. The contrasting performance between the Dow and the tech-heavy Nasdaq, which saw a decline of 0.80%, underscores a bifurcation in market sentiment. Investors are now increasingly turning their focus to sectors that may benefit from a potential pause in rate hikes, such as real estate and utilities. As we look ahead, the interplay between these sectors will be crucial in shaping market dynamics and guiding investment strategies in the coming months. The recently released June jobs report has revealed only 57,000 new jobs created, a stark disappointment compared to expectations of over 100,000. This disappointing figure raises concerns about the ongoing strength of the U.S. economy. Despite this lackluster growth, the unemployment rate has surprisingly fallen to 4.2%, a sign that the labor market is still tight, albeit with weaker job creation. This mixed data has led traders to adjust their expectations for Federal Reserve interest rate hikes, with the likelihood of a September increase falling from over 62% to approximately 50%. The implications of this report are significant, as falling energy prices may ease inflationary pressures, giving the Fed more flexibility in its monetary policy. The weaker job growth suggests that the labor market is cooling, prompting discussions about the sustainability of economic growth. Investors are now closely monitoring how the Fed will respond in the coming weeks. As the economy faces these challenges, the next jobs report will be crucial in determining the direction of Federal Reserve policy. Despite the overall surge in the Dow, tech stocks are facing significant headwinds that are causing concern among investors. Major companies like Tesla and Meta experienced declines of 7.49% and 4.9% respectively, which contributed to a broader sell-off in the Nasdaq Composite, which fell 0.8%. This juxtaposition highlights the ongoing volatility in the tech sector, where strong performances from certain indices do not translate into gains for technology stocks. The pressure on chipmakers has been particularly notable, as industry giants like Nvidia and Intel also reported losses, reflecting a growing skepticism around the future of semiconductor demand. This divergence raises pressing questions about the sustainability of the current market rally, especially as investors become increasingly cautious about tech valuations. The tech sector has been a significant driver of market growth over recent years, making its struggles particularly impactful. As we look ahead, the resilience of tech stocks will be critical to overall market health. Upcoming earnings reports will serve as crucial indicators of performance, and their results could either restore confidence or exacerbate existing fears among investors. Palantir Technologies is experiencing a resurgence in its stock price, following an analyst upgrade citing its unique advantages in artificial intelligence. This positive outlook comes despite a challenging June for the company, signaling renewed investor confidence in its capabilities. Analysts have noted that Palantir's robust AI offerings could position it favorably amidst growing demand for data analytics solutions. Founded in 2003, Palantir has long focused on developing advanced software to help organizations make sense of complex data. As AI technology continues to evolve, firms like Palantir may stand to gain significantly from increased investments in the sector, particularly as businesses seek to harness data for strategic decision-making. The recent stock performance may suggest that investors are beginning to recognize the long-term potential of AI-driven companies. This trend is further bolstered by an overall market shift toward technology solutions that enhance efficiency and predictive capabilities. Looking forward, Palantir's ability to innovate and capitalize on emerging trends will be critical in maintaining this positive momentum. With new partnerships and product developments on the horizon, Palantir is poised to solidify its position in the competitive landscape of AI and data analytics, potentially leading to sustained growth in market valuation. In a remarkable turn of events, the Dow Jones Industrial Average has surged to a historic high, closing at 52,900.7. This significant milestone reflects strong institutional support and investor confidence in the U.S. economy, even as tech stocks grapple with volatility. The market's upward trajectory comes in response to a disappointing jobs report, which has led traders to reevaluate the likelihood of a Federal Reserve rate hike. Historically, the Dow has been a barometer of economic health, and this record high underscores the resilience of traditional industries amid economic uncertainty. Sectors such as real estate and utilities may see renewed interest from investors, particularly as the Fed appears poised to shift its monetary policy. The contrast between the Dow's performance and the struggles in the tech sector highlights a bifurcated market where established companies thrive while technology faces headwinds from rising interest rates and regulatory scrutiny. As we look ahead, the implications of this record high will be profound, potentially altering investor strategies and market dynamics in the coming weeks. Investors will closely monitor the Fed's next moves, as any signs of a more dovish approach could further bolster confidence in traditional sectors. With this backdrop, the focus will likely shift to earnings reports, which could provide insight into the sustainability of this market rally. Thank you for joining us as we explored today's top news stories. Which story surprised you the most? Be sure to like this video and subscribe for more updates on global events.